Thanks for sitting down with me today, Dave, to provide what is sure to be a packed economic update.
Happy to be here, Joe.
So, Dave, we should probably start out with the state of the markets. As I showed earlier in the webinar, together the bond and stock markets have raised about a fifth of the value of the average diversified investment portfolio. How much longer are investors going to see erosion in the value of their hard-earned savings?
Yeah, I wish I could provide you with a definitive answer, Joe, but I can't. As you stated earlier, the current bear market is particularly insidious because it's affected both the stock and the bond markets. Every bear market is unique, and no one can really predict when it's going to end. This chart looks at bear markets a bit differently compared to the slide that you showed earlier, Joe. We define a bear market as when stocks represented by the popular S&P 500 index have declined by more than 20%. Now, over the past 60 years, we've started and ended 8 bear markets. We are currently experiencing the 9th. The 9th could have ended earlier this week, but we won't know until we've reached the prior market high set on the first trading day of this year. As you can see on the chart, Joe, the length and magnitude of every bear market is different. The longest one we've had in the last 60 years occurred with the bursting of the tech bubble. The market lost nearly half of its value. That bear market lasted 2.5 years. We had a bear market with similar losses with the bursting of the housing bubble. That bear market lasted 1.5 years. The most recent bear market prior to today's was the 1 month at the onset of the pandemic when stocks lost 1/3 of their value. I should emphasize that the decline we saw for that 1 month was quite a bit more than the stock losses we've experienced so far this year.
So then, Dave, do you see any parallels between what we're experiencing today and any of the 8 past bear markets that you showed on your earlier slide?
So I guess, Joe, that I can see some parallels with several of the past bear markets. So in 1973 and 74, we had an inflation shock caused by the OPEC oil embargo. We had an even more severe inflation shock in the early 80s with the 2 straight years of double-digit inflation. Then in 1987, we had a spike in interest rates, though rates back then were much higher than what we've seen over the last year. The bear market at the turn of the 21st century is largely attributable to excessive valuations in the tech sector. Then coming out of the pandemic, we had similar frothy valuations among a variety of stocks linked to the pandemic lockdowns. The 2007 to early 2009 bear market resulted from the Great Financial Crisis, or GFC, and is largely attributable to that overheated housing market. As we know, the housing market has been on fire since the start of the pandemic, though what led to the GFC were aggressive lending practices. Banks are much more circumspect today when originating loans. But to state the obvious, Joe, it is inflation and the Federal Reserve's resolve to control inflation that is contributing to the current angst in both the stock and bond markets.
So, Dave, let's dig into that a little bit more. The Federal Reserve continues to message its resolute position that it will aggressively raise the overnight borrowing rate until inflation has receded. I spoke earlier about how the market expects another 1.5% increase in rates, which will take the Fed funds rate to a range of 4.5 to 4.75%. Do you think that this last 1.5% increase will get the job done, and are we finally going to see inflation ebb?
So I wish I could predict what's going to happen with inflation, Joe, and whether the Fed is finally going to get the job done. There are some positive signs that inflation may be receding, but the Fed wants inflation to average 2%. And while I feel reasonably confident that current levels of inflation in the 8% range are unlikely to persist, I'm not at all confident that we're going to get to 2% anytime soon, absent a severe recession.
So let's unpack that a bit, Dave. I have several follow-up questions regarding what you just said. What makes you confident that we can look at inflation rates at 8 and 9% and put them in the rearview mirror?
Well, Joe, let's start by reminding our viewers about the major contributors to U.S. inflation. Housing, food, and transportation account for 3/4 of inflation. Now, this next slide looks at the spikes we've seen in two of those categories. The chart on the left looks at 40 years of food inflation. We've seen a huge spike with food inflation currently running at nearly 11%. And in fact, food at home inflation is up 13%.
So Dave, what's causing the spike in food prices?
I think it's been a confluence of events, Joe. The pandemic caused a massive shift in the food supply chain. We've had a worker shortage that's resulted in higher prices for harvesting, processing, and transporting food. Russia's war hasn't helped, causing a spike in fertilizer prices and a shortage of wheat. It will take a bit of time to adapt, but I do expect for food price increases to come down in the near term, and I don't think we'll continue to see food price increases anywhere near what we've experienced recently. Now, the chart on the right looks at transportation prices. This category is one of the most volatile, tracked by the Bureau of Economic Analysis. Higher gas prices have certainly impacted transportation inflation. We've also had a big bounce back in airfares after they cratered during the first months of the pandemic. Huge demand for new and used cars have also had an impact. Here too, I have less concerns about persistent elevated levels of inflation. We should see a meaningful drop in transportation inflation over the next several months.
So what about shelter? And what are your thoughts about inflation for the largest component of CPI?
Yeah, so that's where I'm a bit concerned about the increases that we've seen in housing. And I'm worried that absent, again, a major recession, that we're likely to continue to see elevated levels in the cost of housing. We've seen massive increases in housing prices since the pandemic. When combined with mortgage rates at generational highs, housing is now less affordable than it's been in a long time. On this slide, we see that inflation for shelter has risen above 6% for the first time since the early 80s. The chart on the right shows a spike for one of the components of shelter inflation, and that's rent inflation. Again, the highest rate increase in 40 years. And I have one last chart on housing that looks at a CPI category tracked by the BEA called Owner's Equivalent Rent. This is a measure of how much money property owners would have to pay in rent to equal the cost of ownership. When the BEA released its monthly inflation report last week, it reported that the inflation for owning a home increased the most since it started tracking this category 40 years ago. If housing prices and mortgage rates remain elevated, I'm afraid that shelter inflation is unlikely to decline anytime soon. This next chart provides additional data on the state of the U.S. housing market. The chart on the left is data from the National Association of Realtors, which takes a different look at the economics of home ownership. The Housing Affordability Index measures at what a typical family earns and the extent to which they can qualify for a mortgage loan on a typical home at the national and regional levels based upon the most recent price and income data. The information in this chart reflects data through the end of July, and I fully expect that once we see the September data, that housing affordability will again be the lowest in nearly 40 years. The two charts on the right reinforces the notion that housing inflation could remain elevated for some time. The top chart shows that housing inventory levels remain near the lowest level in 40 years. And the chart in the bottom shows that apartment vacancy levels remain well below their long-term averages. So again, Joe, absent a meaningful recession, I'm afraid we're likely to see mid-single-digit inflation levels for a segment that makes up 42% of the CPI. And a return to 2% inflation could be a few years out.
So Dave, you just said absent a meaningful recession. Part of the current market narrative is that the Fed will overshoot its efforts to tamp down inflation. What are your current thoughts on the likelihood that we will see a meaningful recession?
So as you know, Joe, the economy contracted in each of the first 2 quarters of the year for a combined 1.5% decline in gross domestic product. But as viewers of our last webinar may recall, 2 consecutive quarters of contraction does not necessarily define a recession. The official arbiter of whether we've entered a recession looks at numerous factors, including employment conditions, personal income, and a few other data points. Employment remains strong. The September unemployment rate was 3.5%, and that's running near 50-year lows. Levels of inflation-adjusted personal income remains steady in 2022 after declines from 2020 and 2021, resulting from a discontinuation of the government stimulus checks. On this slide, we see that the Atlanta Federal Reserve is forecasting 2.8% growth in the third quarter. On the right, we see results from the most recent Wall Street Journal survey of economists. While these numbers aren't all that exciting, so far at least, the consensus isn't calling for a recession in the next 2 years. Now, last week, the International Monetary Fund, or IMF, released its economic forecast for the US and the rest of the world. For this year, for world growth, they're forecasting that it will slow from 6% in 2021 to 3.2% this year, and then next year at 2.7%. And for the United States, the IMF said that our economy will grow at 1.6% this year, but then just 1% in 2023. And while there are those that might lament when they hear that the US economy may grow by less than 2% for 2 consecutive years, I'm not as concerned as others might be. I mean, the reality is that we've seen major disruptions over the last 3 years, starting with the pandemic. So much of how we live our lives have changed. We've had to adapt. We've experienced pain, and we'll experience more pain as we learn to adapt to the current challenges. But as you know, Joe, we believe in human resilience. Remember those 8 bear markets I highlighted earlier? In each of those, we faced significant and unique challenges, yet our economy recovered and markets posted new highs. And I have no reason to believe that this time is different.
Thanks, Dave. I agree. This is a unique bear market and another wall of worry. Also, for each of those 8 periods causing bear markets, there were many that thought that the world had changed and not for the better, but we navigated through the challenges and ended up in a better place than we were before. So let's transition to another topic, and that's the strong US dollar. When was the last time the dollar rose as much as it has in 2022?
Well, Joe, it's been quite a long time. This chart looks at 37 years of history for the US dollar index. 2022 represents the single biggest gain for the dollar over the past 37 years.
So Dave, an overly strong dollar can be problematic for a US investor holding foreign currency as the currency goes down in value. Also, since oil and commodities are priced in dollars, a strong dollar makes food and energy very expensive for foreign countries. So Dave, what's causing the dollar to spike relative to foreign currencies?
So there are a variety of reasons, Joe. First, the 3 most common foreign currencies compared against the dollar are the euro, the British pound, and the Japanese yen. All 3 of these currencies have materially depreciated against the dollar, and for different reasons. So let's start with the pound. We've seen multiple shocks in Britain this year. I've read several stories about what's going on in the British economy, and all basically say the economy's in a shamble. The change in leadership hasn't helped, and the death of the Queen has certainly had a negative psychological impact. But the main factors seem to be high inflation, high housing prices, multiple paralyzing strikes, declining productivity, and poor business confidence. The euro has suffered from the effects of the Russian war and its impact on energy and food. Japan has seen higher inflation, though not nearly as high as we've seen in the US. But its central bank has been insistent on keeping interest rates low. Combine all of this with an aggressive Federal Reserve and US interest rates that are higher than most, but not all, of the developed world, and the result has been unprecedented US dollar strength.
So Dave, how long do you think that we're going to continue to see this current dollar strength?
Yeah, Joe, it's hard to say. Conditions in the UK and Europe don't appear to be improving anytime soon. Many are worried about the upcoming winter and the extent to which the current European energy crisis will adversely affect consumer psyches. A strong dollar is a plus as foreign goods are cheaper, which is going to have a positive impact on our inflation. But the offset is that US goods are more expensive to foreign buyers, which adversely affects corporate profitability and ultimately US jobs. The US has issued an awful lot of debt over the past few years. Foreigners own a meaningful amount of US government bonds. Accordingly, one must be cautious in predicting continued dollar strength.
Okay, thanks, Dave. So let's wrap up by returning to where we started, the state of the U.S. stock market. What can you tell our viewers about stock market valuations?
Well, Joe, as one might expect, with declines as much as 30% for the US and world markets, stocks look a lot cheaper. Corporate earnings have held up reasonably well, and analysts expect mid to high single-digit earnings growth in 2023, although estimate forecasts will certainly change if the economy enters a recession. Let's start by looking at U.S. stock valuations. The left chart on the slide looks at the price to earnings ratio for the 50 largest mega cap U.S. stocks based on analyst forecasts for the next 12 months' earnings. These are your Apples, Amazon, Microsofts, and Googles. And while the PE ratio has come down a lot, it remains above the 20-year average. Hence, one might reasonably expect further declines in the big, large company tech stocks. But take a look at the chart on the right, Joe. The PE ratio for a universe of small company stocks is approaching the lows reached 2 other times over the past 20 plus years. And while prices for these small companies could continue to fall, they certainly appear cheap using the PE metric. The same is true for international stocks. Now, the last slide for my portion of the webinar looks at valuations for developed international stocks on the left and emerging market stocks on the right. Both appear attractive relative to their long-term averages. Now, I also looked at dividend rates for both the developed and emerging market stock markets. Both markets yield more than 3%, with emerging market stocks yielding 3.5%. And again, while I'm not predicting that we've reached bottom, I can take comfort in knowing that international stocks look reasonably cheap. So it's been a tough first 9 months to the year, Joe. But as I showed earlier, bear markets are not rare events. The US and world face many challenges, but we maintain our steadfast belief in human resilience. I do believe that our patience will be rewarded.
Well, thanks for your thoughts, Dave. It's a great discussion in a complex and changing economic landscape.